Welcome to the Euro STR Rising Implications for Banking CAP Talk, our LPA webinar on the IBOR transition. My name is Christian Behm. I'll be your host, and I would like to warmly welcome every one of you who is participating here in tonight, 5 p.m. Frankfurt time on the 27th of April. Good to have you here. We've got a very good participation rate, so seems to be proof that that topic here is of importance to the industry, and that's great to hear. Thank you for tuning in. Participants are coming from all over Europe, from different kind of institutions, so that's really interesting and good to welcome you. I hope you will enjoy that. Let me make a few technical remarks. First, that webinar will be recorded, so you will have also the option then to replay it afterwards or to share it with colleagues if of interest. Second, you have the option to make use of the chat and question function and can participate actively and live in here. We would be very happy to take your questions. Please make use of that options. Put everything in that interests you. We will pick it up either during the event or we have reserved some time for a Q&A session at the end of the session. We will take your questions then. Few words about LPA. Hopefully most of you are already aware of who we are and what we do. We are a European consulting company with a deep domain and foundation in capital markets. We are 20 years on the market, approximately 400 employees, mainly across Europe, doing our first steps into the US markets now. So we are expanding, and our thing is capital markets. So that's the domain where we are, and that's where we have fun with helping and supporting our clients changing and transforming the industry. In case there is anything that you would like to catch up with us, of course, we're also happy to discuss those questions. Besides IBOR transition, we cover a whole wide range of different topics from ESG to crypto and to any other regulation that is relevant for you and to the market, of course. But enough about LPA. I won't be on my own today, and I'm glad that two experts are with me next to my side. If you have tuned in before or in contact with us, you might already know Peter and Stefan. Both of them are well-known IBOR experts and heavily engaged in client projects on that matter. So they do not have only a theoretical view and observing the market, but really solving tangible problems with our clients, and will provide a significant value to you. And they will take the main part of that webinar tonight. So good to have you, Peter. Good to have you, Stefan. Welcome.
Thanks.
Yes, IBOR transition is with us now for quite some time in other currencies like Swiss francs, sterling, currently also dollar. Already a lot of things have happened, and that is not the topic of today's webinar, but there's still euro, and that is also not to be forgotten. You are all aware that Euribor is still on the market. Euro STR has been introduced. So the question is, what brings the future, and what will be the implications then from the banking side? Will Euribor survive, or will it end at some time? this scenario or the other scenario? What happens with Euro STR? Will it replace Euribor? How prominent can it be in a world where Euribor is still live? So that are all most relevant questions to the market, and they are yet to be discussed and answered. And we would like to shed some light on those questions and share our views and opinions and discuss with you tonight, and have arranged the agenda around that. Yes, Stefan, just before we dive deeply into Euro STR, could you give us, please, a short, high-level overview of the reform of the reference rates, please?
Yeah, happy to do that, Chris. So just before we dive into Euro, just a short wrap up. So where are we in the phase of the transition? I think as most of you has recognized, sterling, Swiss franc, and yen LIBOR are not available anymore, and therefore the transition for those currency has been completed mostly in the first quarter of 2022 with most of the banks and clients. If we are looking on the volumes that from European banks that has been transitioned, we see that those currencies were only a very small part of the transition, nearly 10% of exposures on LIBOR/Euribor. And the US dollar is still ahead of us, which is a much more significant part from an exposure perspective, and that need to be done by mid-2023, but that should not be the focus, as you said, of our today's webinar. So our focus is on the exposure, the 60% on top, the Euro exposures, and what is happening with the Euro reference rates. And if we have a look on the current status, I think everybody has seen that Ionia also ceased and is not available anymore, and we have STR in place. And the next milestones we see here and what is happening is that Euribor has overtaken the supervision for ESMA. That was in January 2022, and we have seen that the European Working Group has published a work program for the years 2022 and 2023, and there they have a clear plan to increase the importance of STR. Therefore, they would like to implement a term STR methodology, or not they would like to implement, but they would support the implementation of interested administrators to publish term STR rates. And on the other side, they would like to foster the STR usage in a diverse range of financial products, and not in only, as we see today, in derivatives markets. And yeah, that's the current status of the IBOR transition from an overall perspective.
Stefan, you mentioned that there is a kind of a plan from the working group to promote the use of STR. What's your view on that? Will that be finally successful?
Yeah, it's a very good question. So if we just we put some numbers here on the slide to give you some indications that you all of the participants can come up with their own meaning on that. On the left side, we have tried to figure out the range of the STR share in the Euro market. And if you see here, the share of STR is nowadays bigger than the share of Ionia was in Q3 2021, before the working group published its STR first initiative. So Eonia was about 10 to 15% in the market of the euro market there, and now in the first quarter 2022, we already seen 20 to 35% of STR in the euro market. I think one big part here, besides the STR first initiative, which is came to an replacement of Eonia exposure only, is the switch to RFRs for cross-currency swaps in other currencies. So a lot of cross-currency exposure, or the cross-currencies are now traded against RFRs, which means that also for the euro side, or the euro leg in cross-currency swaps, we have seen that a lot of swaps are now based on STR. And I think that is another part of the story, the market environment. So there is a lot of volatility on euro interest rates, and therefore also hedging needs for short-term interest rates, which also came up or results in a higher need for OIS swaps, which are now traded on STR. And that's why we see such a big volume in STR in the euro market. And now to come back to your question, will we see an STR market which is a substitution of Euribor? Then from my perspective, there are, which is shown on the right side of the slide, there are 4 pieces in that. The first one is we need STR liquidity up to 1 year, which, as we see on the left side, is already there. The second one is that we need, and we came back to that later on, we need a term STR rate, which is much more convenient for clients. So if we need, or if the working group wants to see an adaptation of STR also in client business, then I guess we need a term STR rate, and that is what should be implemented in the second half, I guess, of that year. And afterwards, then it's the holy grail of the questions regarding to STR. Will we see an adaptation in the client business? So will clients or banks see an advantage to use STR and not Euribor in their transactions? And afterwards, if that will happen, then of course also banks will change the trading interbank at the latest and do their bank management, bank steering and hedging also on an STR basis at the latest when the client business will change. So from my perspective, the question is there an advantage for banks or for clients to trade on STR, the client business, and then we will see an STR market which came up after Euribor market.
Super, thank you, Stefan. Peter, the establishment of STR in the client business seems to be key. What could be the drivers for that, or do you see certain challenges or impediments why that shouldn't happen?
Well, I think, thanks, Chris. I think as Stefan also mentioned, we are right now at a situation where basically we have STR now, or Euro STR in the derivatives markets, and it will slowly go into the mainstream cash markets. Just to give you a little idea of what we are actually dealing with, is we have currently around 19 different countries using the euro. And that means these 19 different countries are also using the Euribor as the basis for a short-term market rate. And I think just the sheer size of this market, and with the different jurisdictions, we have in front of us a fairly complex issue. So on the one side, everything that we've done up till now is basically making sure that the derivatives markets can cross over to the risk-free rates. Here we have to see how we can actually get it into the cash markets. And if we're looking at the cash markets, let's be honest and say the cash market in Europe are still local. So there are a lot of different sort of nuances and traditions, even down to sort of different legislations regarding retail, consumer protection, etc. So it is going to be it's going to be an interesting area to watch and to go into. And finally, we have, next to the retail market, we of course have the issue about that we still, on the derivative side, we still have a lot of sort of local documentation around that we also have to deal with when looking at this. But all in all, just to say, Europe is going to be a pretty steep nut, or a pretty steep thing to actually go in and make sure that we can get the risk-free rates into the cash markets. So if we take it from there, let's just do a short recap, if I could, on the next slide, please. And here, basically what we're seeing, all of the IBOR transitions up till now has basically been, we had a LIBOR on the one side and we are replacing it with a risk-free rate on the other side. The structure here is actually very simple because we are going from a term rate to an overnight rate. So we have our daily fixing. That daily fixing is somehow compounded together. Everything is fine. From a cash market perspective, this daily compounding can be difficult to manage. There could be even legal ramifications of doing it. For instance, we have certain jurisdictions within Europe where it's probably not allowed to use in retail business because the client needs to know the rate in advance of an interest rate period and not at the end of the interest rate period. So in that sense, it basically goes in here. And that's why Stefan was actually talking so much about the risk-free term rates being very important for the cash market adaptations. And what we should be very much aware of here is that constructing and creating these term rates actually requires derivatives. So we are in a situation where, in order to get a functioning cash market, we actually need a short-term derivative market in order to basically derive the forward-looking term rate. And that's actually the next big hurdle that we're going to see in Europe is, can we actually get forward-looking STR term rates? The alternative is actually not that good, and that's what we are seeing, for instance, in Switzerland. That is, there is an operational alternative, and that's basically the last reset, where I'm basically taking a past period and using it on a future period. However, they are also the market is also looking at alternatives to the risk-free rate, just to make matters more complicated. We are seeing that discussion, for instance, right now in the US. So we actually, even for the cash markets, we also have to watch out for potential credit sensitive rates coming up. So basically some kind of data vendor or some market creates alternatives to basically establishing a market rate than the risk-free rates. So just when we're looking at Europe, it is an option that we have to consider. But really going forward today, we will focus really on how can the risk-free rate, how can the STR be adapted into the cash market. So looking into that and seeing that transmission here on the next slide. Yes, here we have tried to sort of show the different parts and how they interconnected in order to get this market here. Just a little bit of trivia. The yellow 1 to 10 that I've written on the slide is actually to remind me that if we look by volume, we have 10 times as much notional in the derivatives market currently than typically in the cash market. So what the IBOR transition and also a Euribor transition is all about is basically first making sure that we get the derivatives market correct. We are in a place where we can do that. We have functioning ESTR markets. The ESTR has replaced the Ionia, so that means that we have a clear way forward both for the OTC interest rate market and for the cross currencies markets, as Stefan also said. The next part of the adaptation is basically looking at the wholesale market or the professional market, so to say, here. So here really what we have to see is we need to see the growth of ESTR-based lending. So instead of going in, taking out a credit based on Euribor, that corporates or other large institutions actually go in and take funding in Euribor. And I think that's actually a very interesting thing to follow, is basically to see how the ESTR-based lending is going to go into the market. Secondly, we of course have the issuance. So we will have to watch whether the Euribor issuance will actually move into and becoming an ESTR issuance. That's the thing to look out here. What we might have and what could be done is that we saw on the SONIA market how the Bank of England actually accelerated this process by stating that they would not fully recognize sterling LIBOR-based bonds as collateral from a specific date. So we could actually come into a situation where the central bank is sort of pushing the market into a ESTR-based issuance. What will then happen?
Can I just quickly interrupt? Sorry for that. I've just learned that we've got a technical issue with the Q&A part, so that function just doesn't work for whatever reason here in the setup that we have. But nevertheless, we would be happy to take your questions. In case you have questions and my personal email address, please just send the questions to my email and I will take them up then. If you don't have my email address, you can take IBOR, IBOR at l-p-a.com, ibor@l-p-a.com, or christian.behm@l-p-a.com. Just send it over and we can take them up. Would be happy if there are questions. So just to take that short announcement, Peter, and didn't interrupt your flow. So
it's okay. You didn't interrupt my flow. What we can actually see here is it's not just in the webinar space that we might have technical issues. When we're really looking at the adaptation of ESTR into the professional market in Europe, we actually also have to look at the technical readiness, and that will remain an issue. So that actually has to be catered in as well if we're looking at it. So now back to the retail market. As Stefan said earlier, the key to the retail market is literally, can we get a mature, stable ESTR forward-looking rate? So that is really going to be the big question. What we're seeing here is this question will be dealt with starting in June this year. And hopefully the process that the ESMA and the Euro Working Group is going to embark on will hopefully bring clarity over the over the summer until the late fall here in Europe. So that will really be the important thing. However, there is actually a very important exception that doesn't require the adaptation of a forward-looking ESTR, and that's actually looking at using ESTR as the basis for the interest rate on accounts. So both, you could say, normal deposit accounts or more technically current accounts or settlement accounts. And the thing is, if you look into that, you will actually find the combination of account products based on ESTR and at the same time ESTR-based lending using fixing and arrears actually works very well together. So when we're looking at it, this will probably be one of the avenues to take here when doing it. Okay, so that's sort of what we have to see here. So we're seeing that the building blocks are coming in place, and really a lot of is at the moment waiting for and seeing the results of, can we actually get an ESTR forward rate? Looking at the lessons learned from the other LIBOR replacements, it would be, I just see here, looking at the results of the other LIBOR replacements, I think it's very important to basically say here that Europe will either become, that's at least my prediction, will either become something more like the UK or more like the US. And if we're looking at here, the big difference is in the UK, we have a forward-looking SONIA term rate. In the US, we have a forward-looking SOFR term rate. So both rates are actually available. But in the UK, it's very clear that there is a fairly big reluctance from the banking community to actually use it in contracts. So we are seeing in the UK market, the banks are actually more actively selling SONIA backward compounding into their client base than actually doing using the forward-looking SONIA. Whereas in the US, we are seeing actually very broad adaptation of the CME-based forward-looking SOFR. So regardless of whether we will actually get an ESTR forward-looking term rate, I can just urge everybody to be very, very focused on of saying, just because we have the benchmark or we'll get the benchmark, we don't necessarily can be assured that it will actually be adapted. So I can just basically say every bank participating in this call and every bank you will be talking to, please don't just use a forward-looking ESTR if it's there. Take a very thorough look at, is it actually stable and functioning, not just for the next 2 or 3 years, but actually for the next 30 years. So it's really something to look at. Why am I personally more bullish on the US market? It's basically because they have a very, very long tradition for futures trading. And if we're looking at the forward SOFR, it's actually derived directly off the CME futures strip there. So we have a very deep and very liquid market available, and it's a market that's very difficult to manipulate. So for that matter, and we don't have the same infrastructure and the same tradition in Europe. So I'm a bit afraid that we will actually end up in a situation like the UK. Chris?
Well, thank you, Peter and Stefan. So far, that was really, I found a very interesting overview of the current situation, and hopefully helped to judge the situation. So the question now comes up, what to do next? And I wouldn't be surprised if there are a few challenges waiting in making all those happen. Yeah, certainly the question is around the migration of the business. So is there some, I don't know, lessons learned or some secret sauce from Peter that you can share with the group to make such thing a success?
Yes, definitely. I think it's you basically have a three-prong thing that you have to do. The first thing is focus on getting your fallback language into your contracts. So every new Euribor loan that you're writing, make sure that there is a robust clause in there. How would you actually deal with a potential cessation? It's not just because it's a regulatory requirement, it's part of the EU BMR. So from a pure compliance perspective, it's necessary, but also from a pure practical purpose, you need to make sure that you have your portfolio clean and tidy and ready for a potential cessation. So you could say that's really where you should be starting today if you haven't started already. So make sure that all of your new contracts have robust fallback language in there. Secondly, you have to take a very thorough look at your existing portfolios of your legacies and basically say, where do I need to repaper, or do I have some other mechanisms in place to actually make sure that it's clear what would happen in case Euribor disappears? So no matter what you do, you have to do it, and not just to make compliance happy, but actually to make sure that you can manage your portfolio. The second thing is, now we have the fallbacks done. For that, we have to make sure that the system operations, the risk management systems, the pricing systems, the client information portals, whatever, that they can actually deal with a potential cessation. So how do I change a specific contract from referencing Euribor to referencing STR? How do I actually do that? How do I do the spreads? How am I going to communicate? Are there special letters that I have to send to the client? So really look at what kind of products do you have to support after this. And since we're talking cash products, we are also in the situation that we are talking not just 200, 300, 400 transactions that you can actually manage off an Excel spreadsheet. We could be talking about thousands of contracts that you actually have to migrate. And finally, take a very, very clear look at what is my STR-based offering. What products will I actually offer to the market which are STR-based? So will I use backward-looking STR? Will I use forward-looking STR? How do I actually do that? And at the same time, I actually have to do a very thorough review of my risk management methodologies. Are they actually in place for dealing with the new kinds of risks coming into the book by using sort of a widespread use of overnight index references instead of a term reference or a LIBOR reference or Euribor reference? So really, you have to do this review basically across the whole value chain. So from a legal perspective, operations technology, all the way into your asset liability management processes, both the process itself, but also the whole fund transfer pricing. There is a lot of education you have to do. You have to basically educate your whole client-facing staff so that they actually understand the difference between Euribor and STR and why are the spreads different but still the same. So these are really the key takeaways, and we're seeing with this three-prong approach to it, it's worked for the other LIBOR transitions, and it will definitely also work for the Euribor transition, or a potential Euribor transition.
So maybe just one addition from my side, Peter, if it's okay for you. I think you have said that especially the communication to the sales force will be some big effort here. I would just like to underline that again, because I think if we are looking on US dollar or sterling, we have very capital markets near sales force in the most banks. And in Euroland, maybe there the sales force is not so much into capital markets in a few banks, and the number of contracts is much greater, and the client also maybe are not in, or a bit more away from capital markets. And I guess that is a main issue here with STR products, and not the technical side. I think there in the other currency and different people in the bank, and that is, from my perspective, the biggest challenge here.
I totally agree.
Sorry, just want to underline that again.
Yeah, I totally agree. I think there is next to the purely the technical stuff that you have to do, there is a very big education challenge for each organization here. So, what do you think, Stefan, when we're looking at the asset liability management place, how do you see the challenges there?
Yeah, I think we just selected here 2 additional challenges from a treasury perspective. One is the ALM. So if you look at STR or the other risk-free rates, they have per construction no banking credit risk premium reflected in the reference rate, and that came up with another or might be an issue for ALM, because if funding or if bank credit risk is increasing, we see that the reference rates on the funding side will reflect that. In a case of additional spreads, you need to pay for your funding as a bank, but on the asset side, the reference rates might not reflect that increase in credit risk premium as it was before for Euribor. So your interest income will not increase in such a scenario, all other parameters constant, but your interest expense will increase. So your net interest income will decrease in a banking sector perspective increases, and that is especially more risk in a scenario where you're doing more maturity transformation, or where you have a portfolio where you have more prepayments in your client base. And if those 2 are, or one of those 2 are the case, then that might be an issue for you in these kind of stress scenarios, and that you need to address in your management, and also maybe in your transfer pricing for those new STR products. I think that is one challenge, and the other challenge, which might be more effort to put on, is the bank steering. So we have put that on the next slide. If we are looking on the bank steering, then normally, or you have one benchmark where you are measuring risk on, where you are creating steering impulses on, and so on. And usually in the most banks, that is Euribor, 3 months, 6 months, whatever. And if we came up to a scenario where Euribor might be, or where liquidity for Euribor might decrease, then for sure you don't want to have your bank steering on a less liquid benchmark, because if you're generating the impulses in the bank steering on a benchmark which is not liquid anymore, obviously that is not a good situation. And therefore, you need to observe the market very intensive and see the signs when we might came up with a scenario where liquidity shifts from Euribor to STR, because changing that bank steering is usually also a big IT effort where you might have times of 9 to 12 months to do that, and therefore you need good monitoring of the market situation, which is the right point, or will there be a right point to change the bank steering from a Euribor-based benchmark to STR, and change all the IT systems and processes which are related to the bank steering. So that is, from my perspective, another, or maybe the biggest challenge in the Euro market, except for the one you had said before, Peter, I guess, on a few slides before, the repapering of Euribor contracts, which might be needed in a Euribor cessation scenario, which is, from my perspective, but we came up to that later, something which is a bit more in the future, if we see it, than the bank steering scenario, where you came up in a scenario where Euribor might lose liquidity.
I totally agree. I think the whole steering challenge for the banks is a very important issue, not just because there is some technical stuff to do here, but it actually means that you have to do a very thorough review of your whole risk strategy as such. So there it is. But again, Stefan, I've been looking on a little bit on the Euribor itself and trying to assess whether it's healthy or not. And I have that question here I have this here on this slide here. It's information that's basically, it's published every month by EMI, the administrator of Euribor, and it's what they call the Euribor transparency indicators. And that's basically trying to you can basically, based on these data, you can assess the dependency that Euribor has on the banking panel. So we know at the moment there are 18 banks who are basically providing transactions and expert judgment to EMI, and based on these data, EMI basically does the calculation and fixes Euribor. So if we're looking into that, we are seeing that maximum, we are seeing a level of around below 15% of all fixings are actually done based on market transactions. So that's basically what we're seeing here. So sort of a very, very simple thing. We have 5 fixings a week. 4 of these 5 fixings are somehow derived or expert judgments, just to sort of get you into the mood. And the interesting thing is they actually also provide the underlying volume of transactions that is going in here. What I'm seeing here on the volume side, we're seeing sort of a range of 6 to 7 billion euros of transactions per month in the 3-month Euribor and the 6-month Euribor. If you do sort of a very quick back of the envelope calculation of saying these data was from February this year, they were published here a few weeks ago. If you take these data and say we have 20 trading days in February, we are coming down to sort of a little bit more than 300 million of transactions per day is used to fix 3-month Euribor. However, all transactions below 10 million are disregarded and basically filtered out, which means that we have on average a maximum number of transactions of around 30 transactions per day that's actually used to measure Euribor. So instead of looking at percentages, we can actually see here the dependency that the organization or the dependency on the banking panel remains very high. We see another thing is the so-called level 2.3, which is just basically, it is derived off the transactions and then adjusted given some kind of data. So I'm seeing here that we are getting some questions in here. Chris, what are the questions that are coming in?
Actually, one of the questions we are answering on the next slide, I think, and two others we will take at the end.
Okay, good. So just basically to wrap it up here, if we look at the transparency report on Euribor, my personal opinion is it's not looking good. We are talking about, we have 1,500 daily trades in the OTC derivatives market, which are basically referencing less than 100 daily trades in the underlying cash market. So I think there is sort of a discrepancy, and that's often defined as sort of the inverse pyramid problem, that very few transactions are actually used to price or are used for pricing a very large number of derivatives contracts. So back to you, Stefan, and the question.
Yes, so Chris, should we take the question first, or should I just go into the survey?
Yeah, actually the question is if we could comment on the timeline of a potential Euribor cessation event, what's the view on there? So I think that is exactly what you wanted to elaborate on anyways on that slide. So yeah.
So maybe then I just give some comments on the slide, and hopefully the question is answered then within these comments from my side. So what we have done before, I think those of you who has followed us in LinkedIn has seen that we put up again a survey on the future of Euribor. We have done that already in 1 year ago in June 2021. And the interesting result is that the answers are very close together, I would say. So there is a bit shift in timing between 23 and 24, but the overall answers are nearly the same. So we have asked how long will Euribor be available as reference rate for new contracts? So and what most of the, or 50% of the participants roundabout say, okay, it will happen until the end of 24. And the other 50% say, okay, that will happen after 24. And therefore, I think we have some split between the participants, which is, from my perspective, very representative. If I'm talking to other banks, there are two, I think, positions. The one is that Peter mentioned. So if you're looking on the data, Euribor may not be able to survive in the future. But on the other hand side, there are some arguments from clients. They say, okay, the number of contracts in Europe and the different locations and your restrictions, Peter, I think you also had mentioned that before on the slide, is so big and so complex that a Euribor cessation without a legal guidance is not possible to do an active transition for all of these contracts. And keeping that in mind, we also see the data, but we don't believe in that. And I think these are the two views you can have on that. So if you're looking on the data, I think Peter had said everything on that, that Euribor, just looking on the data, should not be there in at the mid future. And the question that came up is a very interesting one. So how could that be done? I think there are different scenarios. I think, Peter, you also mentioned it before. If we are looking, for example, on the sterling market, we have new business restrictions and cessation of the indice at the same point in time. I think personally, from my point of view, the euro transition, when it came to euro transition, I would think they will go more there like the US transition. So at first, restrictions on new business for Euribor. That is why we placed that question here. And afterwards, a cessation maybe later in the future. And from my personal point of view, then guided with additional legislation to make it easier for everybody to do that transition. And the transition effort will not, from my perspective, stop the change in the new business. So I personally believe in that we see a change in new business from Euribor to STR in, let's say, the next 3 years until the end of 2025.
Thank you all. Peter, would you agree with that opinion, or do you have another view?
No, if we're looking at it, I think the scenario is actually very clear. That is, the first statement that we have to look for is that ESMA basically says, well, we are now starting the end of Euribor. Up till now, we do not have such a communication in the market. So you could say the first entity to do such a communication will have to be ESMA. A natural point of doing it is actually here during this year, because ESMA has taken over stewardship of the Euribor. The next thing is, as Stefan said very correctly, we will then basically get a cessation announcement. And from that cessation announcement, we will then get an announcement of end of new business. And then, of course, when will Euribor all in all disappear? And that will basically be the game here. Whether that's going to be in 24 or 25, let's see. I think given how the market, or the readiness of the market, I think we will have probably 2 years between 2 to 3 years between a statement from ESMA that Euribor is disappearing and Euribor actually disappearing from new contracts, which again brings us to a sort of end of 24, 25-ish scenario. So, any other questions coming in? Chris?
Yes, Peter. Yeah, thank you both first. And I'm very glad that despite the fact that we have the technical issues, 3 questions came. Thank you for contributing those. One we have already taken, and there's 2 left. So let me read the first question. I think, Peter, that might go to you. If not, sure, Stefan will help out. I just read it. Repo markets on euro bonds are still anchored to an Ionia ghost. Do you foresee when there would be a switch to Euro STR, or would it be replaced by a different rate?
Okay, let's say, given my understanding and how the repo market is following, I see the Ionia ghost as being, as you said, it's literally a ghost that we have here. I think the reason why it hasn't changed is simply because it's a matter of time. The economic consequences of actually moving from an Ionia to an STR-based reference is not that big. So I think it's really a question about when do I have to renegotiate my Gisela and my frame agreements in the repo area. So from that side, I don't really see it as an important event. I think it will slowly fade out, what we're seeing here.
Thank you. There's the second question, Stefan, maybe you want to take it. That's the use of term software is excluded from interdealer market, creating a basis risk between loans and the derivatives hedges. Would something similar happen in the euro market?
I see good reasons for the argument from the ARC. So I think the problem here is that if you have the interbank market or too much liquidity from the interbank market also on the term rate, that is missing in the underlying OIS market, and therefore the term markets which are based on that underlying OIS market became less liquid and the rate less robust. And therefore, from my perspective, there are a lot of arguments to do the same framework also for euro, especially when what Peter said also before, we have a term STR rate which is for sure not so robust than the term SOFR, because the liquidity in the US market, especially with its future tradition, is much higher. And therefore, I think also in Europe, they will do everything to keep the liquidity high in the markets underlying term STR, and therefore might also came up with these kind of restrictions.
I totally agree on your analysis, Stefan. It's a pretty dark place to be if we end up with the derivatives market actually referencing itself. So we need to make sure that that we don't get too much liquidity in the derivatives market on the term STR. We need the pure STR to stay there.
Excellent. I think that answered those questions very well. Thank you, Peter. Thank you, Stefan. In case there is anything left and we couldn't answer fully, then please don't hesitate to contact us offline and discuss that bilateral, or if there's in the aftermath anything coming. Very happy to discuss and engage with you. We're really trying to actively foster also the industry exchange, why we have that LinkedIn group where you can find us. You can contact us via email. We have put it on here. And as mentioned at the beginning, we will also share the recording and the slides. When you are interested, then please just send us a note and we will share that with you. That was a great pleasure to have you here as a guest. Thank you for your interest in the topic and tuning in. We hope that you found that valuable and that information that we could share here with you. If there is anything we can help you with, please don't hesitate to reach out. Thank you again, Peter and Stefan, for sharing your insights and also your personal views and opinions. And for me as a host, it was a great pleasure, and I wish everyone a nice evening. Goodbye.